my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of the Chicago soybean complex. I'll start with Chicago soybeans themselves. Beans in the teens and still rising. The weekly key reversal up seen 3 weeks ago was the start of the latest sharp move higher. This after spending most of 2021 within a gently rising bull channel, currently 1385 to 1486. 2 weeks ago we saw a pretty superb follow-on higher to that weekly key reversal up, punching up and outside the bull channel. Indeed, 2 weeks ago I set out some ideas on what may be ahead, and I quote, "The market has utilized the ammunition provided by the upper bull channel line to launch a move higher. We now have overhead 2014 high at 1521 and then the neckline, which is currently 1576, of the old 2010-2014 irregular head and shoulders top. There are two things that must now be considered. Firstly, an initial topside target X for the bull channel would be in the 1596 area. Secondly, let us look at the whole December 2020 to date action as elements of a bullish measured move pattern, in which case we may look at initial target X1 in the 1533 area, eminently doable, and a full target X2 in the 1634 area. These are levels to keep an eye upon." End of quote. Since then the market has hit some of those numbers right on the button, perhaps not the way initially anticipated. Monday's last week's bullish white soldier reached up and achieved target X1. The following Tuesday looked the same, if stronger, but it ran into the previously highlighted resistance of the neckline of the old 2010-2014 irregular head and shoulders top. And this is along with the November 2012 high at 1571 and was stopped dead in its tracks. Indeed, the market started a pullback. However, by last Friday the market had turned back around to the bullish side with a combined key reversal up and a bullish engulfing pattern. Yet the move up on the following Monday was again too swift, and prices were rejected from this overhead resistance between 1571 and 1577. But the rejection was not by as much as previously seen, and we've seen prices slowly move up the rest of this week with a bullish Arami just and a higher yet indecisive doji cross yesterday. Today even higher. Today has been a cautious move higher as prices once again approach the overhead resistance zone. There are elements of an ascending triangle in the past 2 weeks action, even potentially a bull flag, but is not clear enough to warrant it as yet to enable. Overall, we still have targets X and X2 still above. Chicago soybean meal. The weekly key reversals up recently seen in both soybeans and soybean oil, but not here in soybean meal, had an indirect action showing that this market is not immune from bullish incentives elsewhere, though we did not make a weekly key reversal here 3 weeks ago. Prices still nevertheless rose, punching up through the medium moving average currently at 420 even, and the recent 50% Fibonacci line at 423.5. However, despite having gathered ammunition from the 400 to 405 area, it does not appear to be enough. The action in April can be compared to what happened back in March, when prices spent roughly 3 weeks in a range accumulating ammunition and didn't manage to reach 435. This time we had barely a week down there. To be honest, I think it was a pretty good effort to push up over the 50% Fibonacci line, though not reach 440 even. From the bearish engulfing pattern of Tuesday last week, prices have edged lower, below the 50% Fibonacci line, down through the medium moving average, with a good looking combined key reversal down and a bearish engulfing pattern that tested the flatlining short medium moving average, currently 413.5. However, that trip back under the medium moving average last Monday appears to have been one drop lower too many, as the short medium moving average rejected the fall with a bullish Harami Tuesday and a move back up over the 50% Fibonacci line yesterday. These two moving averages are key to the reason why prices pulled back up. Sure, prices gained more recently than they did back in March, but they still fell back, though this time the medium moving average and the short medium moving average were below the market, something that was not there back in March. Hence, this is why we've seen the fall limited and pull back up a little bit. The issue now is that overhead we have a load of congestion between the 50% Fibonacci line and the 38.2% Fibonacci line at 434.80. That's dating from late January to late February, and is fairly evenly balanced as to whether the market will overcome it or it will overcome the market. There is perhaps one other possible bullish feature out there that is still developing that may provide a solution. If we look at the mid-April to date move as possible small bullish measured move higher, then this pattern could be the answer as to which of the two forces ranged here will win out. Now, I have tentatively placed a target X in the 445 area as a result of this potential. Part of me is loath to do so, as this action is not wholly clear and we may end up back at 400 if it fails. But it is best to say so now than look good in hindsight, I think. Chicago bean oil. The mid-January to end of March bullish Andrews pitchfork latterly run this market despite its inauspicious start. The most recent effort in this was the move up over the middle time, currently at 60.18 during the middle of the week before last, moving up right into a congestion band from 2011 and 2012 between 57.64 and 59.73. This lasted about 3 days. Unlike the singular congestion just above that of the 2011 high at 61 even, which occupied the market for all of last week. Indeed, it took a combined key reversal up and bullish closing white Maribozo last Friday to dislodge the market away from 61 even level. That's something to remember on the way down. Anyway, prices moved higher, but from Monday this week we've again seen indecision, as all this week has been indecisive spinning tops. Now, it could be the resistance at 64.84, but I think it is something else, something that showed up last week, plus a longer term thing perhaps as well. Let me explain. Last week the market peaked on Tuesday and ended with an indecisive doji cross. I spoke about it last week thus, and I quote, "We saw the market peak just under the upper time, currently 65.63, of the bullish Andrews pitchfork, an indecisive doji cross, an exceptionally long tongue, and within reach of target X, a possible measured move higher target from the 2021 action so far," end of quote. This week, once again, the market has run up into the upper time and hesitated and backed off. A true and righteous act, you'd say, if ever there was one. Additionally, we have now fulfilled a bullish pattern that has run since the second week of January. Of course, the market's going to hesitate, wouldn't you, if you've done that? If something you started 3.5 months ago has finally come to fruition, of course you'd hesitate. That is why we've halted where we have. This doesn't mean the market isn't still bullish. Of course it is. It is between the middle and upper tines of the bullish Andrews pitchfork. But a period of reflection here, maybe looking to see what pattern or action is to come next, would be a reasonable idea. There's one final nagging point I'd like to discuss. The action from last Friday until today does look like a possible 4-day bearish breakaway pattern. Now, these patterns, when they occur, have a high probability rate, something like 65% of the time they succeed. So caution for the next few days as well. Thank you for listening. This weekly broadcast gives the essential patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.